Welcome to the Opening Bell Report.
Okay, let's just dive right in. If you're looking at your portfolio today, you might honestly think your screen is broken.
It is the story of the day, no question.
It is an absolute explosion. We are recording on Wednesday, February 18th, 2026, and the ticker is IBRX ImmunityBio. And jaw-dropping is, I think it's an understatement.
It really is.
I mean, this isn't some small earnings beat. We're talking about a stock that closed today at $8.54.
Which is a jump of $2.52.
In a single session. That's a 41, almost 42% gain in one day.
It's the kind of move that forces you to pay attention.
Exactly. And here's the part that really got me, and it signals something deeper. The volume. Usually this stock trades, what, maybe 28 million shares?
Yeah, that's about the average, give or take.
Today, 79 million.
Wow.
79. Nearly triple the average. So that tells me this isn't just, a few retail investors chasing a headline. This feels bigger.
It feels institutional.
Right. So the mission for this deep dive is pretty simple.
Yeah.
What is going on here? Is this just smoke, or is there some real fire?
That is the billion-dollar propulsion. And, if you only look at that price chart, you miss the actual story. We have an analysis report in front of us that really unpacks the fundamentals.
Yeah.
And what we're seeing isn't just a lucky day. The report calls it perfect storm.
A perfect storm.
Yeah.
Usually that's a bad thing.
Not in this case. Here, it's a good thing. It's a convergence of three positive forces: cash flow, growth, and new approvals. It's the moment a company fundamentally changes its story.
What was the old story?
For a long time, ImmunityBio was what you'd call a volatile story stock.
Ah, yes. The science project stock.
Exactly. It moves on rumors about trials, but it doesn't actually sell anything. It's all hope. But today suggests that transition is happening. They're moving from a story stock to a commercial entity.
So they're actually selling things now.
And from a technical standpoint, this is what's known as a blue sky breakout.
I love that phrase, blue sky breakout. Break that down for us. What does it mean?
It just means the stock closed above its previous 52-week high, which was around $6.80. Think of that as a ceiling.
Okay.
Every time it hit that price before, people sold. But today, it just smashed right through it.
So the roof is gone?
The roof is gone. There's no angry sellers left trying to break even. The sky is clear, and now the market is looking at those psychological levels, $10, maybe even $12.
So what triggered this? A stock doesn't just wake up and decide to do this. What was the specific catalyst today?
It wasn't a rumor. It was hard news. The European Commission officially approved their main product,
Anktiva, okay? And this is for bladder cancer.
That's right.
Now, approval is always good, but why this massive reaction?
Yeah.
Is the European market really that big of a deal?
It's a major, major de-risking event. In biotech, you can have the best science in the world, but if the regulators don't sign off, you're worth zero.
It doesn't matter.
It doesn't matter. This approval validates their entire platform. It proves, in the eyes of the law, that the science works, and it opens up a brand new revenue stream.
And that leads us right into this idea of the commercial pivot. The report really emphasizes this. We're watching the science project become a launch phase.
And the numbers behind it are pretty wild.
They really are. So we're looking at preliminary revenue for fiscal year 2025. It's about $113 million.
Which, might not sound like a lot compared to big tech.
Right, but context is everything. The growth percentage is what's staggering. It's a greater than 700% year-over-year increase.
700%. That's hypergrowth. That is the hockey stick on the graph finally turning up.
And what about the quality of that revenue? Because if I sell $1 for 99 cents, I can show huge revenue growth, but I'm going out of business.
A great point. But their gross profit is around $100 million.
So the margins are, what, almost 90%?
Between 87 and 90%. Very, very high. It's almost like a software company's margins.
That's incredible for a physical drug.
It is. It shows the core product is extremely profitable to make.
Okay, so let me play the optimist for a second.
No.
700% growth, 90% margins, new EU approval. This sounds like a slam dunk. Why isn't this stock at $100 already? There has to be a but.
There is always a but.
I knew it.
And this is where we need to ground the enthusiasm a bit. Despite all that growth, ImmunityBio is not profitable.
Not even close, right?
Not yet, no. Their operating income is deeply negative, somewhere between $350 and $400 million in losses.
Ouch. So they brought in $113 million, but lost over $400 million.
That's the tension, exactly. Their net income is negative $413 million.
Wow. So where is all that money going?
It's the cost of the launch, building a sales force, managing distribution, and this is key. They're still spending a ton on R&D for other cancers. The overhead just dwarfs the revenue at this stage.
So how do investors even value a company like this? People always talk about a PE ratio, price to earnings.
You can't. There's no E in the PE. The earnings are negative.
Right.
So the analysis report gives us a really useful comparison. They put ImmunityBio next to a competitor, Genmab, ticker GMB.
Okay, so who is Genmab?
Genmab is the mature, stable, older sibling.
Yeah.
They're a cash cow. They're profitable. They trade at a really rational PE ratio of about 13.
Safe. Boring. Got it. And ImmunityBio.
ImmunityBio is the wild child. Since we can't use earnings, we have to use price to sales.
Okay.
Genmab, the safe one, trades at about 6 times its sales.
6 times. Reasonable.
ImmunityBio is trading at a premium of anywhere from 27 to 60 times its sales.
Oh, whoa. Hold on. 60. That's an enormous premium.
It's huge. On paper, it makes the stock look incredibly expensive.
So why would anyone pay that? Why pay 60 times sales for a money-losing company when you can pay 6 times for a profitable one?
Because the market is pricing in the future, not the present.
I see.
Investors are not paying for the $113 million in revenue from last year. They couldn't care less. They're betting that number will balloon to $1 billion or more in the next 2 to 3 years.
They're paying for the slope of the line.
Precisely. If they hit $1 billion in revenue, then buying today at $8.50 is actually cheap. You look like a genius. But, and this is the huge risk, if sales stall.
Then the stock is aggressively, massively overvalued.
And it crashes. It's a high-stakes bet on their execution.
Which brings us to the elephant in the room. You can't get to $1 billion in sales if you run out of money. The report highlights this pretty clearly. The cash runway.
This is the most critical piece of the puzzle right now. We said they're losing money. Specifically, their free cash flow is negative $398 million.
And how much cash do they have on hand?
About $143 million.
Okay, wait. Let me do some quick napkin math here. If you have $143 million, but you're burning almost $400 million a year...
You have less than 6 months of cash left.
Sounds terrifying.
It means they have to raise capital. It's not an if, it's a when. But this is where it gets so interesting and why today's stock price jump is part of that perfect storm.
How? Usually when a company needs cash, the stock goes down.
Usually. But that 40% gain today is a strategic weapon for them.
A weapon. Explain that.
Think about dilution. If the stock was stuck at $3 and they needed to raise $200 million, they'd have to print a massive number of new shares.
Right. It would crush existing shareholders. Your slice of the pie gets tiny.
Exactly. But if they can raise that same $200 million when the stock is at $8.50 or maybe $10,
they have to sell far fewer shares to get the same cash.
It dramatically lowers the pain of dilution. So the high stock price actually helps solve the biggest problem. It's counterintuitive, but the higher it goes, the easier it is for them to fund their own survival.
That makes perfect sense. So the rally is almost a self-fulfilling prophecy.
In a way, yes. It gives them options they didn't have last week.
So besides just needing more cash, is the business itself getting any more efficient?
That's a great question. The report tracks a metric called cash flow percentage of sales. It basically measures how much you burn to generate $1 of revenue.
And what's the trend there?
Well, back in 2024, when sales were tiny, the metric was abysmal. It was negative 2,700%.
Meaning for every dollar they made, they spent $27.
You can't run a lemonade stand like that. It's completely unsustainable.
Right.
But now, with revenue scaling up, that metric has improved to negative 350%.
Still negative, obviously, but that is a massive improvement.
It's a huge improvement. It proves the business model is working. As sales go up, the relative burn goes down. They are still burning cash, but the trajectory is correct.
It's like a heavy cargo plane trying to take off.
Yeah.
It uses the most fuel just getting off the ground, but you're finally seeing the wheels lift.
That is the perfect analogy. They're at full throttle, burning fuel like crazy, but they are finally airborne. The question is, do they have enough fuel to reach cruising altitude?
Okay, so let's tie this all together for the listener. We have a blue sky breakout, we have EU approval, 700% growth, but also this scary cash burn.
Yeah.
What's the consensus from the analysts?
They're surprisingly unified. The report shows a strong buy rating. That's 5 analysts saying buy and 0 saying sell.
0 sells. That's rare for a company losing this much money. What are their price targets?
The average is $11.80, with the high estimate going all the way up to $24.
So even after today's 40% jump, they think there's still room to run.
They do, but the report also includes a warning on the technicals. The RSI, the Relative Strength Index, is above 70.
Which means it's overbought. It's gone up too fast, too soon.
Exactly. It suggests a short-term pullback is possible, maybe likely. So if you see it down 5% tomorrow, don't panic. That's just the market taking a breath.
Right. Don't chase the green candle.
But the real question for you, the listener, isn't about the RSI. It's about that launch phase.
The pivot.
Do you believe they can execute this commercial pivot? Because the stock is technically expensive right now. It is risky because of the cash burn.
No denying that.
But if they succeed, if they can turn this science project into a global business, pulling in $1 billion in sales, then we are witnessing the exact moment that transformation is happening.
The moment the science project became a business.
Precisely. It's a moment of validation, but you have to watch that cash burn number. That is the fuel gauge. If they can raise money at these prices, they survive and thrive. If they falter, the fall is steep.
A perfect place to leave it. High risk, high reward. Keep your eyes on the cash. Thanks for diving deep with us today on ImmunityBio.
My pleasure.
Don't forget to like, share, and subscribe for more.